Coming to you live from downtown Detroit, this is Benzinga's PreMarket Prep. With your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day. Good morning, everybody. Welcome to this Monday edition of Benzinga's PreMarket Prep. Hope you all had a great weekend. Spencer, Isreal, Joel Elconin, and Dennis Dick with you this morning. We're going to talk about the fireworks at Friday's close. We have some M&A in the railroads from over the weekend to discuss. We have some weird stuff happening over in Turkey. AstraZeneca is in the news. We got a lot to get to on today's show. Maybe we'll even get to the ARK Invest Tesla price target if we feel like it. Our guest today, Tim Quast, is the founder and CEO of ModernIR and Market Structure Edge. He would join the show at 8:35. And Chaim Siegel, head of U.S. equity research at Elazar Advisors. He would join the show at 9. Today's show is also sponsored by Market Structure Edge, the first decision support platform for traders built on market structure. To learn more, go to marketstructureedge.com. The link should be up on the screen right about now. Joel, let's go to your charts, and everyone smash that like button for Joel's charts and tell us how we're doing this morning.
Is it Chaim or Chaim?
I don't know.
Because I had Uncle Chaim.
It's okay.
C-H-A-I-M. Is this H-A-I-M?
No, it's C-H.
Oh, okay. So it's Chaim. It's not Chaim. It's Chaim. Come on.
That's
March Madness, folks.
Yeah.
That's all I can say. March Madness. Holy mackerel. I think I haven't even looked at my brackets. I think even if Michigan wins, I don't even think I have a chance then. But madness in the markets on Friday's close. We'll talk about that with Triple D when he comes on here in just a few minutes. S&P futures, week close, week open, but we're in the green by 6 3/4 handles at 39.0675. Pre-market high 39.11. Have nothing there for you. Pre-market low 38.85. I have nothing there for you either. Last week's low, Friday's low, down at 38.75. That's our bogey on the downside. Crude getting off the mat. Big sell-off last week. Up 25 cents only, though, at 61.27. Gold in that range, 1,700 to 1,750, down $7 to 1734.60. Silver, that's going the same way. That's down about 6 cents at 25.73. And every time I look at Bitcoin, it looks like we're at like 57,000, 58,000. We're trading down $1,355 at 57,620. So we'll bring in Triple D. Triple D, how was the weekend and how was that close on Friday?
Crazy close. A lot of gaps on the close. Yeah. Well, we have the quad witch, so we're expecting some fireworks. We got them. There was a lot of gaps. I mean, there was a lot of runs, where you see the big imbalance and they're just buying them into the imbalance or selling them in the imbalance. The stocks were going both ways. Check out AVGO. Look at the chart there in the last 10 minutes.
Okay.
Went from 460 to 475. Obviously, big buyer there on the close. And you can see the big green bar. So
how do you do it? Do you try and go with it, or do you try and fade it, or do you just leave this one alone?
I used to see, because the information comes out at 350, so you could then go with it if you
inclined.
Yeah, if you want to, you can go with it. But a lot of times they flip around, and so there's a risk in doing that. Is it going to flip on you and then catch all the traders that were going with it? I typically just fade the moves. If they have a big gap up on the close, I'm shorting. If they have a big gap down, I'm buying it. And that's typically how I do it. Again, it's a kind of market that, weird things happen in, but these moves are based on order flow, not based on market fundamentals. So typically, from a quantitative perspective, they give it back. So if you see something that moved down $3 on the close, typically, relatively speaking, obviously, if you have market effects involved on all these stocks, I mean, the market's ripping this morning, so to expect AVGO to just be down $15 isn't, realistic. It's a it's a tech stock. Techs are ripping here this morning, so it's going to have some life from that. But if you're chasing up AVGO this morning, you're saying, oh, well, it's only up 0.3%. Qs are up more. The reason it's not up more is because it had a 15-point run on the close. It was trading down a little bit after hours on that. But there's a ton of other ones, too. I mean, look at UPS. Here's another one. Gap down and ran down on the close from 162 all the way down to 159. So that's a big 3-point move. These are serious moves.
Yeah.
Especially if you're trading any type of short-term day trading stuff. I mean, there's big money to be made here. FNF, a smaller company there. Again, financial's getting pounded here this morning, but it got hit really hard in the close from 41 down to 39.34. You're talking about a 3.5-4% move there in a matter of 10 minutes.
No bounce. Not much of a bounce in this one.
Well, you're not gonna get much of a bounce because it's a financial, and TLT's way up here today. So you got to look market effects always. So other things being equal, if the market and everything's flat, you would expect a little bit of a bounce in FNF. But because TLT is up, banks are down. If you look, Bank of America trading down 1.5%, JP Morgan trading 1%. This isn't down much. This is actually trading up a little bit here this morning. So there is a little bit of bounce happening because if obviously this happened, right, financial will probably be down with the TLT trading up. So, it's only one, impact is that, obviously there's always, other influences on the market. The overall market influences individual stocks as well. But typically I fade the moves. So I'm running algorithms that are, providing liquidity into the close. And and like I said, I love the LOC order, limit on close. So you send that out. If you were buying LOC, FNF 40, you get filled with closing print of 39.34 long. So some of those work well. I got MasterCard on the close. I flipped it out. A couple minutes later. Visa was crazy because Visa had news, but it got hit pretty hard on the close too. I'm just trying to remember. I got Disney on the close. I bought Disney. I remember this one I bought on the close. I bought at 90, the closing print, I think, which was 91.14, 191.14, and I think I flipped it out at like 191.60 after hours, like about a minute later. So, it's a quick 0.5%. So that's how you pay the bills if you're, a prop trader. Quick 0.5%. Like I said, I'll enter a trade for a 0.1% edge. You get a 0.5% edge. That's a pretty good edge.
And Coca-Cola. Man, oh man, I hope you were out there at 51.
I got short a bunch of Coke on the closing print as well. And I wasn't out there ahead of time. So, 51 would have been good. So, obviously, sometimes what happens is you'll see the big buy imbalance. It'll actually get oversubscribed to, and it can actually flip and go down on the close. So it actually came in a little bit on the close, and then it's coming in a little bit more. But that was a wicked move for Coke, too, running up 1% in the last 6-7 minutes. A stock that moves 1%, all throughout the day typically, moved 1% in the last, 5 minutes. So these are big moves.
Yeah, that one too. I mean, just from an order flow perspective, a nice, round number like 51 stopped just above it the day before. So I know you don't have time to factor in all those things when you're, when you're putting out the orders. But you said Pepsi had a big move too, correct?
I'm trying to remember. I remember getting filled. Yeah, Pepsi ran up. So if you can look this big move, Pepsi running up. You'd expect it to give it back, but it got an upgrade this morning. So it's even going farther. Yeah, so it's going a little bit farther there, but that was a big move for Pepsi there too. So obviously, an analyst doesn't look at the gaps and don't care. Dennis, they paid up a little bit on this upgrade.
Dennis, I'm wondering if you noticed the S&P rebalance because those things had a very interesting move at the close. The stocks that were being added to the S&P all dropped, and the stocks that are being removed all popped.
What? Give us that list if you have.
So Penn National, right?
That got destroyed last week.
Was going in, yeah, but I'm saying look at the close though. Penn National
dropped,
right? Not NXPI.
Caesars.
Sorry, NXPI.
Yeah,
Caesars and Generac. They all went in,
and they all got hit on the close.
Yep, and then the ones that were leaving the index, the S&P 500. Flowserve, FLS, and then Xerox, right? Mm-hmm. And then SLG. Well,
these all got hit. These got hit too. They hit everything.
That got hit too. Now I'm looking at it. Yeah. Okay.
They look like they hit everything. There was a lot of sell imbalances on close. A lot more stocks got hit than were getting bought. But like I said, there was a few outliers like AVGO that ran up 15 points on the close. So Pepsi ran up. There was some going the other way too. So I know a lot of people listen to this. They're like, oh no, we want to talk stock picks. And what do we want? I'm trying to teach you guys like how, you know, a prop trader looks at the markets and how, you know, other professional traders look at the markets and try to extract edge from that. So this is all about extracting edge. You know, when you see these big imbalances, they're going to move price. You know, we can look at charts all we want. Chart is meaningless in the last 10 minutes of a quad witch when you got a huge buy imbalance. It is going to push price. So, you know, these are edges that, you know, we can exploit in the market just by obviously having that information, which is publicly available information, and then using that and knowing how to use it. So Joel giving you, you know, the one way we used to always do was going with it for the first 10 minutes and then flipping it on the close. Like I said, in the last few years, it's been trickier because they flip them around. There's a lot of institutional action. There's some gaming of this happening too. So I feel like the only safe edge is usually the fade. So,
all right. How about Merger Monday?
let's do it.
This was out over the weekend, which you don't see too often. But yeah, Canadian Pacific is buying Kansas City Southern. So CP is buying ticker KSU for a deal that values it at $25 billion.
Is it stock or cash?
It is a.
I'm assuming because CP is down, it's a stock deal.
It is both, actually. It is a cash and stock deal.
You got a ratio?
So I do have a ratio. I'm so glad you asked. Shareholders of Kansas City will receive 0.489 shares of CP.
0.489.
0.49 shares of CP for every share of Kansas City that they own.
So that's for you risk arbs out there, that's your ratio. Don't trade these 1-to-1 when they got a significant cash component too. You use the ratio 0.489. So basically, if they're getting 0.489 for every buck that CP moves, KSU will move 50 cents. That's an easy way to think about it. So usually the first day I'll let our risk arb shenanigans shake itself out, and then I'll start trading the relationship. So I like to trade all these things. There is opportunity still there. So
you know,
CP KSU.
You know, you only have to kick yourself in the butt for not being long as KSU. This has been out there for a long time.
It was in play with Blackstone, I think, last year.
I think, or was it even longer ago? Was it last year? I can't remember.
KSU was in play for a while.
Yeah.
It's a good call. Like I can remember this being rumored here, like 180.
Yeah.
So it finally does materialize. Like I don't think CP was on the radar, but this was back in October, I believe, of last year. You can maybe we can even go find on the charts.
Was it?
There was a spike up a couple days, maybe when it went into play.
I think it was in the summer. I thought it got to
might have been the summer.
Yeah, it might have been the summer.
It was September. It was like September 2020. It was September. That's when it was.
September. Okay. Yeah, you see the pop there. No antitrust issues here. I mean, how many railroads are there? How many railroads are there?
There's like 4.
Right? Yeah, no, there could be. That's a good call. It's definitely. So give us the ratio. We could calculate what the risk arbs are pricing that in already. So ratio 0.489. What was the cash component?
Oh, good question. You
gotta know the cash in order to tell you the discount.
I know. Okay, it's 90 in cash.
So you're gonna get $90 in cash, and then you're gonna get 0.489. So if we take the current price of CP, let's say 370, just showing you how to calculate it. Your grade 1 math. I guess it's grade 2 times 0.489. Give you $180. Say 181 the current price plus a 90 on there, which gets you to 270. KSU is currently trading at 261. So they're only giving a 9-point discount. Not much. Is that too little, you think, Joel? The antitrust?
I don't know. I
3%
mean,
discount?
I just think about how many railroads. I mean, you never know.
It looks like it's too little to me.
Yeah.
So, careful. KSU, obviously watch CP because CP goes up. KSU is going to go up that 50 cents for every buck it moves, but only a 3% discount. That doesn't seem like very much. And people on the first day are all excited. They just buy. They see 270. There's a lot of uninformed money out there too. They just see 270. They're like, oh, it's 261. Why would I not just buy it? Don't kid yourself. There's people that are actually doing that out there. So, that can sometimes push the price up a little bit higher than it wants to be, but I would have thought a little more discount, but maybe there's not any antitrust issues. It's not out round. It's not way out to lunch, I think. Only a 3% discount, but
so it's notable because this is the first time that there's going to be one connected railway, one company controlling railway that connects Mexico, the U.S., and Canada. So that's why this is notable. So antitrust, I don't know. This industry is not very competitive. There's like 4 railroads that I can think of, right? Companies. There's these 2. There's Union Pacific, and there's CSX, right? Those are like the 4 that and there's Norfolk Southern, right? I guess 5. Those are the ones that I can think of. And
so NSC trading up 3% here this morning in sympathy. CSX also trading up 4% in sympathy here. CNI, interesting enough, it was down earlier, but it's now turned green. The other big Canadian one, like when I was trading down, I was like, are they thinking this one's going to acquire Mike? It's pretty small. But Canadian National also trading up here. So we're seeing a little sympathy pop in the other rails with the deal. Railroad deals, Merger Monday. Anything else in Merger land?
No, not really. We do have some chaos though in Turkey. If you want to go there for a minute,
in macro.
You want to look at the TUR ETF?
Yeah, and I got a small position in this, and it's not good.
Let me guess.
That's why you stay diversified, folks.
How do you hedge a turkey ETF? What are you doing? Turkey grease or something, Dennis?
Yeah, no, that one's not a good one. The wrong side of that one. It is very small, and I'm so glad it's very small because it's still kicking the crap out of me.
I know.
Yeah. So what happened is the President Erdogan fired for the 3rd time. Fired the head of the central bank in Turkey, and this guy had just raised rates. Right, like was it November and December? It just raised rates, and he's out, and the lira took a beating, and the market was halted for volatility. And the really easiest way for any of us to get exposure is just that TUR that Joel has up on this.
Yeah.
I mean, you could trade the lira if you want, but.
Hey, Dennis, too bad there's like not a mashed potato ETF. You could have, hit.
Joel, come on.
I trade everything, man.
You could No, but I know with these, that's just a tough correlation. But anyways, let's see here. Down 5 sticks. I mean, usually Brazil does this every once in a while too. Yeah. I mean, maybe hold out. I at this point, since I know absolutely nothing about investing in Turkey, which I'm glad. I see a monthly low at 23.33. That's kind of where you're trading. Just like with Brazil, and these, it seems like they do this. They stay down for a while, then they kind of claw their way back. But that is a very, not for informational purposes. That's just, I think that's what I remember. So if not, great monthly support in Turkey under $18, but I don't think we're going to see that today.
This is where the pro movers tool comes in handy, because if I look at what's down this morning, what's down the most, I see TUR, and then I also see TKC, which is Turkcell something or other.
Some type of company in Turkey.
Some type of company, but the point is they're in Turkey. That's the point. They're in Turkey. Yeah,
there's not a lot of Turkey stocks.
There aren't a lot. There aren't a lot. Right?
We found you one. TKC.
But there's one. TKC. There you go.
Someone asked in the chat. We got someone pretty smart in the chat. They asked if you traded that this morning. I don't know who it was. I think it was a new guy.
Turkey.
I can't remember, but that's good. Good call. Are there any other turkey stocks?
Hey, chat, if you have any turkey stocks, drop them in, because we don't really.
Yeah, I don't know. A little bit late now, but that wasn't a pretty looking chart going into it anyways.
No.
But,
that gives back its entire year of earnings in one day, pretty much. Or year of gains just gone. Kaplooey. More than the year. Well, not the year, but the 2021. It was actually doing okay for the year. Boom, gone. No, not doing well.
Lowell says, I used to live there.
Political risk.
Loved it, yeah.
Geopolitical risk.
That'll do it. Every time. Politics will get you every time. All right, it's 8:20. We'll have Tim Quast on in about 15 minutes. Do we want to get to Tesla, or do you want to go?
Yeah, for sure.
Do you have a Kathy Wood segment? I was thinking, that.
No, I haven't got
that Motown song, "Knock on Wood." I found it the other day. Come on.
Okay.
All right, let's do it.
So I guess this is a sign of how out of whack or how high my expectations were. Is when I heard ARK Invest's new price target on Tesla, which is 3,000 by 2025. my first thought was, oh, that actually seems like kind of low to me. That's how crazy this is. That's how crazy this
Kind
is.
of low.
3,000. Anyway, their bear case.
What would the market cap be?
Their bear
At
case
3,000?
is 15. It would be like several $1 trillion.
Like the most valuable company in the world by far.
Well, I don't know what their price targets on Apple are for that same period, but yeah, it'd be up there. The bear case, $1,500 a share by
That's the bear case.
2025.
The bear case. So the worst case, Kathy sees the worst case scenario.
Yep.
For Tesla being $1,500 a share. The worst case scenario.
Bull case,
like the cars start catching fire, like the solar doesn't work out, like everybody decides that EV isn't cool and they go back to gas guzzling. But in that worst case scenario, stock would still be $1,500.
Bull case 4,000. The biggest thing that I saw was that they're basically saying we think there's a 50% chance that in the next 4 years, Tesla is going to have 100% self-driving capabilities.
I believe that. I think there's a good chance that Tesla leads the autonomous. Nothing wrong with Tesla company at all, besides maybe Musk being a little crazy sometimes. I mean, this company has been innovative. There's no doubt it's deserving of a premium market cap to the other auto companies. There's no doubt. It's just when you start, I don't know how you can keep extrapolating. I know she's got some funky math there and can figure it out. But and she was right before. So, could she be right here again? It's a funny market. I mean, they're buying farts. We saw this in the New York Post. People are paying money for somebody that taped their farts for a year. I mean, you have, investors buying digital art.
Great idea.
Well, it's just, we're in this silly market right now that nothing really matters anyway. So price can go really wherever it wants. I mean, we got GameStop that won't come down. Still trading here at $200, despite not even being close to fundamentally. There's no fundamental case for GameStop at $200. Doesn't matter. When the markets are completely disconnected from fundamentals like they are, and I think a little bit's coming back in. I think if we were talking 3 months ago to where we are now, the markets are starting to care about fundamentals a little bit. That's why you've seen the PE stocks, the low ones, go up and the higher ones come down. They're starting to actually care a little bit. Are they going to stop caring again? Maybe. Could Tesla go to 3,000? It absolutely could. It could go anywhere it wants. Am I going to be participating in that? Maybe from a day trading perspective, is Tesla going to enter my long-term portfolio? No, because the valuations are stupid. So, they've grown, and you could say they've grown into the valuation. Well, they haven't really, though. The market's just given it even a more ridiculous valuation. And that might continue. That could continue for a long, long time. And maybe it continues forever. And maybe we're going to a market that's never going to care about valuation again. But, I was looking at buying another house this weekend. I was just doing the quick math. And I'm like, it was a rental property. And I'm like looking at it. And I'm like, well, I know building costs and what you're building. So I'm building another house. And I'm like, there's literally a house being sold for more than the cost to build it from scratch right now. And the house is 20 years old. I'm like, that's where it's starting to get stupid. When you've got a 20-year-old house that is trading above what it would cost to build the house brand new. So, I mean, we're in some bubbles and some different things. That's really what drives real estate. And it's a wicked tangent I went on. But what really drives real estate is building costs.
Of course.
Costs.
Yeah.
We never talk to stuff, but I do invest in real estate too. But what really drives it is the input costs. So, if it costs you $500,000 to build a house, that a house is 20 years old, should trade at a slight discount to that because you're getting a used house. It's like buying a used car. You're getting a used house. People always want brand new. So usually, you can look at your home builders and say that, if they're building at $300 a square foot or $350 a square foot, depending, it can range. I mean, depending on how nice it is. But once you're in real estate for a little bit, you can take a quick look and say, okay, this is middle of the road. They're going to build this at $300 a square foot. So I can do the quick math and say it's 2,000 square foot home. It's $600,000 house, roughly speaking.
Easy. Yeah.
Yeah.
Easy math.
And then you got a lot that's worth 150, a house worth 750. You can go like that if you were to do it brand new. And then you look and the house is going to sell for 800,000. It's like, all right, I'm not going to buy a used house for more than it costs to build. That's where you start to get into, a real estate bubble. If you're buying houses and the build is, the build cost to rebuild is 600,000, you're buying the house for 400,000, then you're getting a discount. That's where it starts to make sense. So, and I've taken this from Tesla, but, that's the math that we're in is people are paying up and they're paying, ridiculous amounts for everything right now. So,
It's
in the
doubled.
stocks,
I mean,
well,
it's
the real estate
basically
market's nuts in
3
Canada
or 4
anyways.
years. Yeah, well, here
And
too.
everywhere, really.
So what you're saying is that Tesla's stock is going to go up by 50% every single year for the next 4 years. That's basically what it comes down to.
I think Tesla's going to sell more cars. And we can say the revenues are probably going to go up. There would have to really be something drastically happen that Tesla revenues don't go up. It's just already trading at a crazy valuation. So I guess if you extrapolate it from the current valuation and say it's still going to be trading at the current valuation with higher revenues, the stock price is going to go higher. What I think is going to have a PE contraction on it eventually, where the growth isn't happening. That happens with every single stock. Maybe Tesla's going to be the one stock ever that didn't happen to. But I mean, eventually you can't just take the current valuation, extrapolate it with sales, and then come up with a $3,000 price target. Now, I didn't look at her specific little math. I'm sure Kathy's done some other stuff with that too. But give her some props. She's the one analyst. Just put her on the map. She's been correct on this the whole time. But, she's also very influential this morning. Let's talk about that because it's up 24 points this morning because Kathy said it's worth $3,000 and the worst case scenario is $1,500. That's why the stock is up 24 points this morning. So by her saying that, she just put some significant money into her ARC funds by her saying that. Take that with what you, with what you want.
I mean, when I saw this over the weekend too, and I mean, it's fine. You can make these kind of calls, but I look at this and I'm like, well, it's a long way through getting through 720. I mean, that's a major resistance area. You had a big break. You're flirting with a whole number. And I mean, to me, if you, I don't want to get crazy here, but you had to move from 900 to 550, 350 point move. You got to bounce here to over 700. I'm not going to project this move off from this 700 top, but I mean, doesn't she look at that and say, wow, man, look at that resistance is 720.
No, probably
man.
not.
We're $70 away. How the hell are we going to get over 720?
Probably not. Is the answer to the question.
No earnings. I mean, when's
they have
earnings
coming. They're going to make money. This is not a cash burn situation anymore.
Not anymore.
And when I was writing the puts back, with what I had wrote the 120s and they were paying me $20 for those puts. Remember, I did that like a year and a half ago because I said I don't think Tesla is a bankruptcy situation. Somebody that's buying the 120 puts, and this was pre-split. So you're talking about the stock, at like $20 puts. They would be, because of the split. I mean, if you were buying those puts, you were saying it's going bankrupt. I was on the show 2 years ago saying, I don't think Tesla's going bankrupt. I said, if it really got into trouble, some other company's going to buy for the technology. So, Jeremy Newsom was writing puts. He had talked me into it. I was like, I totally agree. I wrote puts on it as well. Those puts expire worthless. I cover it because I'm always going to cover to you soon. But, it was a good trade for me. And I was long the stock at one point in time, too. I just felt like it had gotten silly, especially, when even Musk had said, when the stock ran to 700, he thought it was getting overdone. Well, stock now is, 5 times that because it's 654 times, the split. So, even Musk thought his price was overdone. But, Kathy doesn't. And that's what people who listen, people listen to Kathy Woods more than anyone in this market right now. So if she says it's worth 3,000, there's going to be a lot of buyers at least the next morning. And that's what we're seeing here today.
Just keep at pre-market high 685. Let's look at it from, I could give you some intermediate numbers here, but I'm just going to 720. Look at all those highs there, 3-4 highs, struggling now with 700. I would say with the Kathy pop, if you don't get this thing back over 700, close it over 700 today, then I think that's a bad day for it. It already looks like it's rolling over just a tad. What's your 2-day high? You're not even at your 2-day high yet, 689.23, and then you start to get into those highs in the 700s. Does anybody know what I'm looking on TradeStation, what the lumber is? I'm looking for it. It has to be at L something. If anybody can help me out, I just like to look at the lumber futures. But anyways, Tesla, house building, quite a tangent there. 831, S&P's leaking just a tad. 4 minutes before Tim comes on to talk market structure. Where do you want to go, Spencer?
Yeah, hold on. I almost have an answer for you, I think.
Okay.
Try LB. Try like LB/LB or at LB.
At LB. That's it. And I knew it was something. No.
All right.
No. All right, someone else will help us.
I don't
out
know.
with that.
Sorry. And a couple things on that on the ARK Invest Tesla note. Yeah.
Oh, you go to the Wood ETF. I mean, that was easy.
Yeah.
I mean, look at that. Look at that thing. Rocket ship.
The as our chat is pointing out, their analysis, their models do give a lot of credence to Tesla's insurance revenue, which is right now only in California, but they're counting on that expanding. And the other thing I'll just say on the Tesla on ARK Invest is they were right in terms of the stock price and what the stock did, but they were right for the wrong reasons, right? Because the fundamental things that they were pricing in didn't really happen.
What were they pricing in?
Well, I'm just talking, just like the fundamental development of the company in terms of sales and credits and all these things.
They want a multiple expansion.
Right. They won on they won because the stock went crazy because the stock went up, but they didn't win because the business did what they said it was going to do. Right. It's a different thing. They were right for the wrong reason. So what that means for these next few years, God only knows. I don't know if you noticed this on Friday, guys, but ARK Invest was extremely quiet. They only bought
nothing.
They bought 3 things on Friday, and that is it. They bought 3 things. They sold 3 things.
What did they buy?
That was it.
What did they buy?
They bought Fate, F-A-T-E.
Which they've been buying every day.
Yep. They bought one, AONE, and they bought Teladoc. And that is it. They really, really quiet day.
And they've been buying Teladoc, and these are 3 stocks they've been buying pretty much every day.
Yep.
It's crazy that they continue to buy the same stocks every day, yet they continue to get Kathy Pops every day. It's like I don't get why they continue to get that. And people think I got to hate on for Kathy Wood here. I'm just saying her valuation methods, are aggressive. I'm not saying she's been unbelievable. She has built herself a following better than maybe any other following out there right now. So you've got to give her props, and she's very smart. She get her on. Jason Raznick did a great interview with her. She's crazy smart. I'm just saying, we've seen these growth investors, that just buy at any cost. We've seen this before, and we've seen it in 96, 97, 98, 99. So you've just got to be careful just paying anything for growth. So I don't agree with how she with just buying growth at any cost. I'm a fan of growth at a reasonable cost. So I've underperformed, guaranteed, in my long-term portfolio. I've underperformed Kathy. She's loaded up with Tesla. Tesla went up like 600-700%.
Everybody's going to underperform Kathy.
She's been unbelievable. So by all means, like if you've been doing really well with her, continue to do what you do. I just I'm in it for like 20, 30, 40 years. I got burned by actually playing just like Kathy Woods back in 1999. And I'm just careful with it now. In 2007, the same thing. It works awesome in bull markets. If you get into a bear market, we saw that just a little glimpse, in February and towards the beginning of March here with the NASDAQ pullback. I mean, the markets pull back 3, 4, 5%. Her fund goes down 25%. So it's just a leveraged play on the market is really what it is. Mm-hmm. So market's going to go up. NASDAQ making new highs. Kathy's going to outperform. So if you think the NASDAQ's going up, then they're going to make new highs, you probably want to be long Kathy.
All right. It is 8:35 on Monday, which means it is that time. Tim Quast, good morning, sir. How are we doing?
Good. How are you guys? Good to see you. Happy Monday to you.
Happy Monday to you as well. Anything jump out to you last week in the markets, or just kind of more of the same?
Well, I figured Dennis would be taking me to task today over tech.
I'm giving you heat? Why? I don't give heat. It's not like I just gave Kathy Woods heat for the last 20 minutes. I don't give heat.
Well, last Monday, Tim, you were bullish tech, were you not?
Yes, I was. Yep.
Well,
so we pull back a little bit here.
Makes the market.
Yeah, but that's okay. What are you saying on tech now? We pulled back a little bit here. Are you still bullish tech even on the pullback here?
Well, so remember, the only way I look at the market is through the lens of market structure.
Yeah.
So, the rules and the behavior of money behind price and volume. So if I continue to say that the market cannot perform well if the 50% of the market cap that is comprised of tech. If you look at tech and you look at consumer discretionary and communication services, and you sprinkle tech through all three of those, if people are owning those things, this is the question we should be asking. If people are owning those things, then that part of the market has to reflect how the overall market behaves. So one of the things that we do internally is we look at the performance of ETFs, exchange traded funds, like Kathy's, and we compare them to the stocks that comprise those instruments. And so and if you look at the two things over the entire market last week, so there are 11 sectors, and if you look at the underlying stocks and the S&P 500, the S&P 500 was basically flat. And yet the stocks comprising the market were down 2%. So the question then arises, how is it possible for these instruments that are supposed to track the market to diverge so dramatically from the underlying stocks? And if you take energy as a case in point, the energy ETF from State Street, XLE, was down 2 basis points last week. Yet the underlying stocks, the basket that comprises it, were down 7%. So how is that possible? You could say, well, thankfully I own the ETF and not the underlying stocks. But the point of the matter is that the ETF is supposed to track what the underlying basket of stocks is doing. So why is that not occurring in the stock market? And you would say, traders who are listening to this, why would you care? Well, you should know what is occurring in the stock market. So how is it possible for that ETF to do well and the underlying basket to not do well?
Explain.
Please enlighten me on this.
Yeah, explain that.
All right, so I think it all ties into what happened last week, which was quad witching. So quad witching means that there are expirations of derivatives that are futures and options tied to indexes and individual stocks. That's how you get 4. So if you depend on derivatives instead of owning the stocks, there's a possibility that what you do differs from the stocks. And there's even a bigger reason. So suppose that you're BlackRock and you're running trillions of dollars of exchange traded funds, and you don't want stuff that's going down. So if you're interacting with, say, Morgan Stanley is your authorized participant who brings you a basket of stocks in exchange for shares of ETFs to offer to the public. Suppose you say to Morgan Stanley, we don't want ExxonMobil and Chevron and all this stuff because that stuff is going down. But if you give us a check, just some cash, we'll take that instead. And that's called cash in lieu. And so where am I going with all this for you traders? There's a point here. There's a lesson for all of us who are trying to trade and do so successfully. But here's what can happen. So a Kathy Wood can, in the same vein, could take cash instead of Tesla. If I don't want Tesla stock, I could tell my broker, I just want a check in place of the stock that the rest of us own. And so then the ETF does better than the rest of us. And the question then is that okay? Is that okay with all of us?
I mean, the whole point to it, like having authorized participants, is so that the index, obviously the ETF tracks the basket of stocks very closely. If 7% difference, why would authorized participants not just be coming in and then building the basket and then obviously turning it into XLE? Right.
So let's look at that.
Why are they not doing that then?
Right. Well, right. So here's the trading point. I'm going to share my screen, or at least attempt to do so, because you would want to know. This is the whole point for traders. You would want to know if that is occurring. And how would you know? How would you know? Well, let's come over here, and I happen to have, so you can do this, traders. Go to marketstructureedge.com, and you can look at this too. And I've got GameStop on my screen because we're going to lead into energy. And you say, well, GameStop has nothing to do with energy. Well, that's the point. In the stock market, there is a set of rules that determine how things occur, and they're the same for everybody. So if you want to know if Kathy Wood is using cash in lieu, it will show up here. So here's GameStop. And what this is showing us is, here's sentiment. Sentiment is merely a measure of supply and demand. Everything is about supply and demand. And so if you looked at GameStop and look at short volume, short volume is the percentage of trading volume coming from borrowed stock. And notice that all along here, it's about 60%. And look at what sentiment did on the 18th, and the 19th is ticking down. So we know that the citadels of the world are manufacturing stock believing that it's going to go down. All right, so let's go look at energy. This is telling us you would not want to own GameStop. And I don't care how powerful Wall Street Bets is. If Citadel knows, looking at the supply and demand, that there is no longer an exchange of shares occurring, if there's anything going on, it's cash in lieu. This is what's going to happen to GameStop. It's going to go down. All right, so let's go look at energy. I'm going to go over here to the dashboard and just pull up the energy sector. And there are, in this basket, 139 stocks. And so we look who's leading, fast trading. All right, so let's go look at the supply-demand balance in this. Whoops, let me go back. It's going to show up. I want to go back and look at this and talk about cash in lieu. So look at short volume. There's the trend in energy, and it's the very same trend as we saw in GameStop. So it doesn't matter whether it's energy or if it's communication services or tech. If the supply of stock is rising and sentiment is falling, then we know that whoever has to balance out their portfolios at options expirations each month isn't doing it with stock. They're doing it with cash. And what will that do to the prices of things? Well, they'll decline. It's that simple. And you can see it in the math. So, it's one of my bones of contention with regulation in the market that this is possible.
Yeah, it doesn't sound possible. So,
right. So what are the other applications of this knowledge? How else can we use this knowledge?
Well, let's talk about tech, right? I said tech. If we're going to follow the market and we're going to follow that 50% of market cap that has to be tied to tech, then we should see people buying tech. So let's go look at it. So much. Pardon me.
How quickly does this data change? Like, how quickly do you see? And obviously, is this like something that's over the course of days, or can it change in the course of hours? How quickly does the market sentiment change?
So it ebbs and flows in about 10-day increments. Remember, if we go back all the way back to February, remember, Dennis, you and I talked about this February 22nd, and I said the market will struggle for roughly 10 days. And why is that? Well, because there's a period of time in the markets between when people put money to work in 401ks, let's say, and when derivatives that can be used as substitutes for stock positions come due. That's about the third week of the month. And then the ends of months when all these funds have to true up their tracking to the market. So it's a very important concept for traders. You don't have to be a high frequency trader like a Citadel or a Virtu or a 2 Sigma or a Hudson River Trading. Mm-hmm. If you understand that these things move in increments, that's how the market works. So looking at tech, look at tech here. And it hasn't done as well as I thought it would. And we're not through this yet, by the way. I still have, so I grew up on a cattle ranch. And so I'm going to use a rodeo analogy because I rode things that bucked. So I like to be out of my stock positions into expirations because you don't know what's going to happen. But if you're on that horse and the chute opens, now you're stuck for 8 seconds. You're going to have to ride this thing. And that's how, and that's often how it is.
I get bucked off stocks all the time.
Right, exactly. Well, so we talked about Palantir, and we should look at Palantir, and we will. But look at this. So look at the short volume trend in tech and sentiment. I mean, here's where they topped, right? This is where everybody should have been out of the market, right there. February 12th. Yep. Yeah. That was the point.
That'd be a good sell, actually.
Right.
February 12th.
Now look where it is today. So sentiment right now is at, so as of the Friday, we're at 7.6, and the market tends to trade between 4 and 6. So we're bucking out of the chute, and yet we haven't gotten the returns that should have been delivered with this kind of recovery from below 5 to above 5. Let me explain this for traders. So the whole market has supply and demand. And if demand exceeds supply, stocks are above 5. If supply exceeds demand, they're below 5. And the whole tech sector, 400 companies there. And notice who's leading. The behavior that is leading is passive investment, exactly as you would expect around options expirations, where everybody has to rebalance their portfolios. But what are they doing? I think they're using cash in lieu. And this is why the tech sector has not done as well as you would expect. If everybody had to go out and say, you're underweight tech, I need to own Apple because Apple is supposed to be 10% of my portfolio and it's 7%. Well, what if I just take a check instead? Well, Apple will not rise. That's what happens. And how important is that from a trading perspective? Well, I mean, it's difficult, right? We're getting into the weeds there. But the beautiful thing is with Market Structure Edge, you don't have to worry about that. You just look at short volume. The short volume is rising and sentiment is topping. You know, it tells you right there that you're going to have a very difficult time delivering results. I'm going to go to Palantir. I should
that everybody wants to talk about all the time.
Right. Let's go look at it. Right. So
it's tired.
Probably, I would say, like, I get requests from traders all the time. You know, obviously, take your time, but individually sent to me, a lot. Like, a lot of tip through Twitter. Some people find my email. It's just literally, a lot of different ways that people ask me about stocks.
Right.
I would say probably the stock I get asked the most, and it's multiple times a week, is Palantir. PLTR. People love this stock. They love talking about it. They want to be in this stock. This is the stock that people want to talk about.
Right. And so here's how I look at it. And I like it too, right? I said I like Palantir. And if I'd followed my wife Karen's suggestion, I told her, Palantir is, look at the sentiment, look at short volume, looks awesome. And she said, you should sell it before options expirations. And she was correct. I mean, there was a great return in Palantir, but here's the problem. If that this concept that I'm talking about, where ETFs that own $5 trillion worth of stocks in the US market decide not to buy it, but instead to use a substitute like derivatives, like futures or options or cash, then what happens is this. Sentiment peaked right there. Now, you don't, it doesn't mean that Palantir, any opportunity in Palantir is over, because it's still above 5. There is implied demand, but it means that in the next couple of days, if you own Palantir and it rises, you should take that money and run. Here's beautiful Palantir. Sentiment at 10. Then here's where short volume pops above trend. That's where you should leave. If short volume is way above trend, there's your opportunity. And you don't buy it till the sentiment ticks up again. But this is the problem. It's the options expirations period that I think for traders is very challenging. And it's because there is so much substitution occurring. And maybe we all have to learn to avoid about the 18th of every month.
As an investor.
Maybe.
Right. Yeah.
What do you think about the quad witches as turning points in the market? I mean, you've seen that, you had the gamma unwind last March and stuff. I mean, I think this is a big week for the market. I mean, I can sit tight. I really do, because I mean, it was just Thursday and the spoos were 75 handles higher than this overnight.
Right.
And we sold off. You made the Friday low, the weekly low. And now you're just getting bounced. It just doesn't feel like you're just going to rip this thing up. I mean, I could be wrong, but it just doesn't feel like we're ripping right back up to 39.50, 4,000. What does your work tell you on the major turning points on the quad witches?
Well, that's a great observation, Joel. Because if you go back and I think it becomes bigger and bigger. If you consider that there are only so many stocks, so we could have 370 SPACs come public over the last year, but that does not change the fact that we've got the planet is awash in money, and that money wants to be in equities and bonds and various other things. But let's just think of it this way, right? NFTs, art, real estate, it will find its way into things. But if you're going to try to true up how you track a benchmark, those things are always going to tie to expirations periods. And so you could look at the end of the year, you could look at each quarter, and I think these things become bigger and bigger and bigger because there isn't enough underlying equity to satisfy all of the money. So what does it do? It looks for a substitute, like a derivative. And that's why I think increasingly we as traders need to be very careful around these options expirations periods, and particularly the quarterly ones. So next one is June, but still we've got one coming up in April. That's going to matter. Today, by the way, new options trade. I think it will be a very good day for tech, because instead of buying stocks, everybody will look for options. And I don't mean the traders. I mean BlackRock, Vanguard, and State Street. They're going to use options and futures to substitute for stocks, because they can offload the risk of being exposed to Tesla or Apple or Microsoft to Goldman Sachs if they just have an option. So then tomorrow's Counterparty Tuesday, all the banks will true up their books. I think Monday, Tuesday are going to be very good days for tech for that reason. But if they're up, you should be out, I think.
Tim Quast is the founder and CEO of Market Structure Edge. You can learn more by going to the website. The link is up on the screen right now, marketstructureedge.com. Tim, always a pleasure.
Good to see you guys.
Week.
All right.
All right, let's do some ticker time, guys. We've got 5 minutes left here before I'm going to bring on our next guest. So let's do some ticker time. Drop your tickers in the chat. We will cover them as quickly as we can. I know Palantir was already up there, so we've already got one down. So we got.
Oh boy! I don't know. This looks tired to me.
Yeah,
I don't.
I get support 22 to 23.
Yeah,
but it's not. But it's had so many. It's had so many Kathy pops.
And here we go. Okay, we're going. Let's go quick. Let's talk about Baba.
Ooh, the Bobster.
It's had a nice pop here. There's still so many unknowns here. So
Joel.
I'm long it. I stay long it.
I know, wrong stock.
But it's technically it looks okay down there. It's just so many unknowns. We don't know how this
Yeah.
is all going to shake out with the monopolistic stuff and the regulation in China. They're obviously still on, Jack Ma's still not in favor there.
The story never ends.
Yeah, there's a lot more stories still to come here. So that scares me to buy more.
4-star resistance, 241.50.
All right. Nike had earnings last week. It's been a couple of days now.
It seems like Nike always bounces back. Lots of support, 130 to 135. I'd love it down at 130. I don't know if you get there. It's the kind of stock people want to own. It's the kind of stock they'll eventually buy the dip on, I think. So hard to be bearish Nike.
I'm going to take the other side of that trade.
Yeah, I love it.
Yeah,
I love it. I love it.
Well, when I was talking with Rob about it on Stock Odds last night, he said it doesn't have the greatest probability of being up today. Also, I think some people got caught. You got up to that all-time high. You failed. You had a bad day. I think some people are like, you know what? I am not going to wait for this to get back to 142, and I think they'll be selling today. No, unless you take out that low from Friday, no major downside, but I think you just drift today.
Okay, speaking of a stock people want to own, what about DraftKings? People really want to own that thing.
Well, and you got the March Madness too. So you've had a madness run a little bit here in both Penn and DraftKings. Those long Penn over the weekend. It's getting a little bit of love here just because I thought the madness might pop these stocks on Monday morning, and it is. It's been a great run for DraftKings. Valuation's crazy, but it's a storied stock. It's sitting up near the highs, and if the bull market continues, this is one that's probably going to eventually drive to 100. So all depends on the overall market, but this is the strongest stock, one of the strongest ones. So the story is still there. Sports are still there unless COVID comes and, it goes the second wave and the vaccine's stops working. I mean, you got to think DraftKings, the story is still unfolding, and I think it still goes higher.
74.09, that's your all-time high. Someone's working out of a piece at 73.50 as we speak. So I'm not buying it up here. I'd look at that as resistance.
I'm not buying it either up here.
73.50 to 74. I just think
I'd buy it on pullbacks though.
I think eventually people are just going to run out of money. I mean, that's
eventually they're not going to gamble. People are going to stop gambling.
I mean,
we know.
Also, I love
people are going to eventually stop gambling because they're going to be broke.
Joel has no confidence in the average.
You got the Powell printing press.
Okay, I know.
Which is on forever apparently. From last week's commentary. So
okay. I just love this.
Let's gamble with the government's money.
All right, go what?
I'm not in the car very much, right?
Yeah.
But every time I'm in the car and I hear an ad for DraftKings or whatever, there's like 47 of these different apps now. Mm-hmm. What do they say immediately afterwards?
Well, no, that's because they have to.
Right. Right.
That's because there's a law saying if you don't point people to a gambling addiction hotline, then you're in trouble.
I've seen the signs in the casinos, 25 years ago, you go in there and they got the gambling addiction hotlines there, but the casinos are still packed here 25 years later.
Yeah.
Oh, they're not packed right now.
All right, maybe not.
No, they're doing it online.
It's
a trend. I mean, I don't know.
Would you buy casino stocks? I mean, the reopening's happening.
We haven't looked at those. Let's look at MGM and Wynn and LVS.
Lisa doesn't like Vegas, so I'm not buying.
I bought the Wynn back at like $95 or something,
and sold it at 96.
Yeah, you know how I am myself. But it's been a hell of a run. It's come back.
That's come a long way back there ever since that sexual scandal that it had.
The reopening trade is on.
That was a long time ago when Steve Wynn got in all kinds of trouble, right?
Well, he's out. He's been out. So
yeah, he's been out.
Right. I don't know. I mean, it's like a Boeing. Like Boeing finally took back half of that move. Mm-hmm. Remember that? We were talking about that for a long time. How Boeing had to take back 50%, and it did, and they exceeded it a little bit. But then it lost it. The 50% came in at 268, peeled back. So I figure that out on your win, and that's what I'll be looking at. Resistance, 200 to 40? 160, 80, 120. So you're over it now. I don't know. Let's see if you can get to that next high next month. I don't see it. 137.58. That's my number. Monthly high, February of last year.
All right, we had Tim Quast on the show before. He's bullish tech, at least in the short term. Going to have another someone who I believe is another tech bull. Chaim Siegel head of U.S. equity research at Elazar Advisors, joining us now for the very first time on pre-market prep. Chaim, good morning.
Hi guys, great to be here. Thanks for having me.
We got a functioning camera, functioning microphone. We hear you, we see you. Let's talk. So
ready to go.
You are you're still long-term secular bullish, big tech, right?
Well, I look at stocks fundamentally, but okay. I like to, shorter term, I like to look at the technicals, and I think that's important. So fundamentals right now are very strong, no doubt about it. I speak to a lot of companies every quarter, mostly the big cap tech companies, and I think people are very bullish. I think companies are very bullish. You just have companies not getting the supply they need in semis, and that's going down the chain. So companies need to order. There seems to be demand because of COVID and data and things like that. But I think there's a new change at the margin that's coming that's potentially risky. So I'm not totally bullish on stocks right now, or the Qs, or tech right now. Fundamentally, yes. Technically, probably no. I think there's more. There's risk out there, I think.
Maybe more of a short-term sideways-ish move is what you're saying.
I'm not sure. I mean, we go from bottoms up to top down. So I got all riled up with the Fed meeting last week. I thought they showed in between the lines zero confidence in this economy. They showed their dot plot in 2023. And they were asked 3 times by reporters, Wednesday, and Fed Chair Powell had no answer. They asked him, "Your dot plot says you're gonna keep rates until 2023, but you're gonna hit all your targets. Why don't you start raising rates?" And he had no answer to the same question 3 times. And the answer is he has no confidence in this economy without Fed support. He also said this economy is doing great because of Fed support. So they have a problem. They have a big problem. And I think if you saw the close on Wednesday, it traded weak. It was a good day. Everybody was bullish because the market was up, but the close on Wednesday was weak. I didn't like that close, and I told subscribers to get net short ETFs for Thursday just because I hated that close, and I really didn't like what Fed Chair Powell said. And the other thing I think that's crazy, and that everybody believes him, is that they're saying inflation is transitory. Do you know that? Do they know that? There's no way that they know that. I mean, inflation is just starting to pick up.
Yeah.
They know it's transitory. I mean, they know the COVID cases are going to go down. Transitory inflation is picking up because there's a lot of backup in supply chains. That's one reason, but you also have oil moving up. I think that's inflationary. I don't think we know if that's transitory.
Well, regarding the dot plot, didn't Powell say basically like to not look at that? It wasn't that like that was his answer, right? He was like, "Don't look at that." I thought that's
right. Don't look at that, even though that's what we all think. Don't look at what we think.
Yeah.
I'll tell you another thing that they don't say a lot lately, but they used to say a lot. And this was just a few years ago, but they can't say it because they need to instill confidence that they're going to keep rates at 0 forever, which is not true. I don't believe it's true because once you get inflation, they're going to have to raise rates. They have no choice. Mm-hmm. So that's the big risk building in this story. You're seeing it with bonds dropping pretty much every day. But you asked me a question. I got off track. But
no. So that's all good commentary, though. If we can go to like a specific area of the market, though, I think prior to this weekend, you probably had one of the higher Tesla price targets out there, right?
Right.
You're up in the.
We just downgraded it actually last week.
Oh, did you? I didn't even see that.
Yes, and we lowered our earnings. Actually, we had earnings much higher for 2021 and 2022. I mean, we've been one of the biggest bulls on Tesla for a couple of years now. I think we were one of the few people way above the street and saying they're going to make money. and having, ridiculous price targets at the time, a year and 2 years ago.
Yeah.
But it was just based on our earnings target multiplied by 45 or 55 PE. We've been using higher than that lately, 65 PE as our max. But I think that there's problems because of, the semi shortage and supply problems for Tesla. And if you notice that estimates for deliveries have also been coming down through the quarter. I mean, you never liked that. I mean, I really liked, what you guys were talking about on your last segment. And you're basically saying, I think it was Dennis was saying that, stocks, maybe Tesla will go up on bad news. But I think we're at risk for Tesla coming on a period of more negative news. Our estimates are finally now below the street for the next couple of quarters because, Q4, they had issues in gross margins and they said it was just one time, but now they have sourcing problems. And so I think they may need to, use air shipping and different things like that. They might have another problem with gross margins this quarter. And so, and a lot of these problems are based on, COVID, and COVID was going down, but that curve has started to reaccelerate. And I think that's a problem for them. And so our numbers came down. So we're below the street. We went to neutral after being at a buy. After the earnings last quarter, which was near the highs, we went from strong buy to buy just because of the gross margins. We didn't like that. And so now, and we also in our model portfolio, we got to like a 0% position just because we didn't like how it was acting. And we thought the news was not as good as people, there's a lot of just perma bulls out there that, close their eyes to the fundamentals. But I think the fundamentals are not as good near term. I think the fundamentals are great long term, but I mean, we say it all the time to our subscribers. The long term is just a series of short terms. So you gotta kind of nail that too. So you can't close your eyes to this.
What about Zoom? That's a question that I asked the chat for tickers a few moments ago, and somebody threw out Zoom, and that's a stock that you cover as well. It's gotten punished off the earnings report. Really, not just that. Really, since last fall, but the all-time high was hit in October. So since then. But what do you make of Zoom, I guess, like near term and longer term?
Great. So I think Zoom got killed on the earnings because, there were just a bunch of funds that knew that the earnings would be good or thought the earnings would be good. But, we're worried about this post-COVID world and, getting back to old school, basic economy stuff and selling, the companies that benefited from COVID, which, Zoom is the poster child for benefiting from COVID, having, 500% growth rates, pretty good. So I think that, the company gave amazing, very strong guidance. Here, I'm pulling up the numbers, but they gave very strong guidance for the next quarter. And, so they're saying they're being conservative, but they gave very strong guidance. I like to look at the 2-year revenue growth rate. And I think that's really important here for Zoom because, you had such a strange year last year. Let's compare it to 2 years ago when things were more normal. And let's see what the growth rates are. And the growth rates are amazing. So, and plus, short term, I think this is very important. If you have a lot of traders watching this too, with that COVID curve going up, I think this makes sense. I mean, this is the first time I tell subscribers, when I want to try to get big again. And Zoom, we've been very patient, and I'm just starting to want to, give it a toe in the water because it seems like it's has a chance to hold. And also with the COVID news, I think is a change. But here's the growth rates on a 2-year basis. This is revenue growth rates the last 4 quarters. 272% for Q1, 450 Q2, 450 Q3, 447 Q4. And
wait, but that was all during COVID though. So
this is all during COVID, but it's comparing versus 2 years ago. So it's kind of washing out the last year. and saying what's the growth rates versus 2 years ago. So when we go back to normal, we're going to have to lap these numbers. So yes, the 1 year number is going to come back, but the 2 year number may not come back so much. You don't know, because I mean, all we hear about, I mean, you're out there and I hear a lot of companies talking about using Zoom. You know, it's just out there, and it's very strong. COVID isn't going away right away. I mean, it's getting worse a little bit near term, unfortunately. So I think this is a real company, a real stock. I think they have a real positioning. We have huge earnings, I think much higher than the street. The street's for this year, they're at 370. I mean, we have like 3 times that for this year. So
the argument against Zoom, and we can move this into like the entire tech sector, really, because the argument against Zoom or any of these companies is valuation, right? Does the valuation make any logical sense? What do you make of all of these, whether they're a COVID stock or not, all these tech companies that have valuations that seem high, and maybe in hindsight not, but like at this moment in history, they seem high.
I agree. So look, when you have the Fed keeping rates at 0%, by definition, valuations are going to go high, because when you're doing these discounted cash flow valuations, then your denominator is low because of rates, and so the future cash flows, when they're discounted back, are a higher valuation. So it makes sense. What I use is I use the midpoint of the last 3-year PE. So I'm not using a high PE or what it's trading at now or the low. I'm using midpoint. And so a lot of stocks don't fall into our filter. We cover about 50 of the biggest cap companies. So I agree that stocks are highly valued. But if rates start to go up, which they are, that's what's hitting tech.
Wait, so you said you use the median of the last, so like in Zoom, for example, you're not looking at Zoom's PE today, you're looking at Zoom's PE, the median over the last 3 years, and that's how you base your analysis?
Let me, so this is what I do for all companies. So Zoom, I'm sure it's higher than that. So I have a max 65 PE I'll use for any company if I think it's worthy. So I've been using 65 PE for Zoom. I'm just trying to pull it up. Give me a second.
Yeah.
But Zoom, I think, is traded much higher than that on a PE basis. So my numbers times 65 times get me 50% upside from where the stock is. So I'm okay with Zoom's valuation, but there are a ton of stocks, cloud stocks, and a ton of stocks out there that are just way past. I have Zoom. Their last year or two traded between 100 and 400 times PE. I'm using 65 times, and I like the stock based on the potential earnings. So I don't.
So that's, again, that 65 is the median PE ratio over the last 3 years for Zoom. Is that
no? 65 is my max PE. The median for Zoom is 200 times.
Okay.
But I'm not using that. The market is wrong a lot on the future earnings expectation.
Okay.
So Zoom, it's wrong because it's assuming that their revenues will fall off a cliff to get to that type of earnings number. The growth rates will slow immensely to get to those type of earnings numbers. I don't think that's so realistic. I mean, the company is seeing it real time, and they're, a company wants to be conservative. Zoom has been accused of being very conservative. They were not last quarter. They're seeing great results right now. I hear you. If COVID, the curve comes down, well, we don't know. But the curve already came down, and their growth rate didn't slow.
Yeah. All right. Chaim Siegel is head of U.S. equity research at Elazar Advisors. Chaim, thank you so much for coming on. Happy Passover. We'll have to get you back again soon.
Thanks.
Thanks a lot. All right, guys, smash the like. I always love getting new blood on the show. New guests. Smash the like for Chaim. We appreciate that. He's like 8 hours ahead of us, so thanks a lot to him. Thanks to Tim Quast for joining us as well today. Thanks to all of you in our chat. To all of our chats, right? We've got the YouTube chat. We've got the Benzinga.com chat, which is benzinga.com/premarketprep. And we've got the Benzinga Pro chat, plus the chats on Facebook and Twitch and Twitter. I can't be everywhere. I apologize. I'm sure there's a lot in chat that I missed. I'm sorry. Our YouTube chat is the most active chat, so I do pay most attention to that, but I am watching as many of them as I can throughout the course of the show. Thank you very much. Be a trader for life. I appreciate that. Guys, this show is also available as a podcast, right? If you miss the show, you want to listen in the car or whatever, we're on every major podcast platform. For all of you podcast listeners, please remember all the information from our show is meant to be used as informational purposes, not for investing or trading advice.